Recording is on, and you will receive a link to the recording afterwards. Let's see. Yeah. Good afternoon. Yes. I will start by sharing my screen. And the case we're doing today, I sent you the case, which is now, well, it could be any case, but this time it's an airline considering to open a new route to a smaller town and buying an airplane for that purpose and making some restoration on the airfield and we will model the business as such. It's for a 10-year period, only this first period of operations. And then we will analyze the profitability. But yeah, I will utilize Invest for Excel and do it step by step. So the main thing is that you will see how to model with Invest for Excel easily. Just remember that it could be any case. And we have 1 hour, so I will start. I will start Invest for Excel by clicking the icon. And it opens the start screen where I can access different parts of the program. And also it replaced Excel's menu with Invest for Excel's own menu here on top, where you can access directly Invest for Excel functionality. But you can always switch to Excel menus because you need Excel functions every now and then. And when you have Excel menu visible, you also have access. The last item here in the Excel menu is now Invest for Excel menu in the shorter version. But most of the functions are directly here, so you can work it with Excel menu and still access most of the Invest for Excel functions right here. But you can also switch back and forth because you have Invest menus here at last item, so you can go back to Invest for Excel menu. Generally, when you make a calculation, you start here top left with some basic assumptions for a calculation. How long term, how detailed, I mean in periodization, do you work on annual basis or monthly basis or something else? And it can also be different periodizations in the same calculation. Very often the investment phase is a little bit more detailed and then operations on annual basis. Then your own contact information, and in the investment table you put your capital expenditures and choose depreciation methods. In income statement you do the modeling for the case, how the income is calculated, how the costs are calculated. You can create sub rows on 3 levels so that you can model your business as detailed as you like. And there are operators between the lines, so it makes it easier. And anyway, the income statement will then show the profitability of the product or business in selected periodization. And then you can also see the need for working capital. If you have a business or a project, it usually also requires some money to run the operations. So you don't get paid immediately when you sell something. So you have sales receivables and you have accounts receivables and you have inventory perhaps for your production. So it calculates the value of the inventory, and you also have a term of payment for suppliers. So accounts payable is calculated easily here also. And this could be also important because it impacts cash flow, and cash flow impacts profitability. So the next is the cash flow report, gives you a good overview of how money moves and what the need for financing is, and gives a possibility to cover the need for financing with debt and equity. A balance sheet is automatically created You can have an opening balance also if you have some old assets you want to include. Or if it's an ongoing operations, you can have 6 years backwards historical income statements and balance sheets and make your forecast based on that. And then you see the overall profitability in the profitability analysis screen. Here is like indicator showing the profitability for the whole life cycle. So it's net present value, payback, internal rate of return, and many other similar ratios. And then you create an Excel workbook calculation file, and then you usually make different versions of it. There is never just one way to do it. There is different technological solutions, different suppliers, different size of investment, different time schedules, competing projects. So you've made slight changes to the calculation, and then you have version number 2 and 3 and 4, and you always push the calculated result to comparison table. So you have them side by side the results of the different options. So you can choose the best option and then very easily then present for management why you selected a specific option. And then continue also with sensitivity analysis, discount factor like the cost of capital or required rate of return. So with different rates, what if the investment costs more or less? How does it impact? What if income is less or more? Production costs, fixed costs, any selectable variable. So whatever rows you create in your calculation, they can all be selected for sensitivity analysis. So you can have many at the same time. And also with the charts function, you can create different types. You can create tornado analysis, you can create spider charts, you can create Excel charts, you can also make break-even analysis, you can make Monte Carlo simulations, DuPont analysis. So there is a lot of different types of what-if analysis. One important functionality here is also the marginal effect, where you can compare situation before investment to the situation after investment. So you make, if you consider to make an additional investment, maybe you make it more efficient, or maybe you save energy, or maybe you increase capacity, or just modernize or replace. So we have, first you make a calculation about what it looks like if you don't do anything. Then you save the new name, and then you add the additional investments and how you think they will impact on operations. But you can't look at the B calculation only either, because it includes both old and new. So by pressing create here, Invest for Excel automatically creates a third calculation, a complete calculation with all functionality, showing only the marginal effect, the difference between before and after investment. And this is then the investment calculation. This should be profitable. And this works even if you just have costs, you have just the investment cost, you just have the maintenance costs, you have the cost for operations. So only negative numbers, you can't maybe not connect it to the income. So still, if B alternative is more efficient, you get a payback here and a positive IRR and a positive net present value. Just by choosing one file here, another file there, and press create. Consolidation is adding together different projects or businesses just by picking them from a list of calculations. And they can be totally different to structure, to periodization, to variables. Invest for Excel can still consolidate them to a new file showing the aggregated number, the summed up numbers of all these projects. And if they are companies like subsidiaries in a group, it can also consolidate to form the forward-looking financial statements of the group companies. It does eliminations of intercompany transactions on the go, and you can choose on which level of group you consolidate. And even if you have an international group, it will also do currency exchanges on the go. Impairment test verification is more for accounting. If there is some business not going as well as planned, then you need to test if you need to write down the goodwill and book value of assets. So there's a function for that also. The investment proposal is a form summary for management for investment decision. It brings numbers from the calculation, but then you add additional information about the project in the form and send it for decision. And if you get the green light, there's still also the financing module where you can add debt financing to your calculation. It works in combination, of course, with equity earning cash flows. It takes it into account. And the financing model is smart. You can import the cash flows from the calculation so that you can match the loan withdrawals with the investment phase, the construction phase of so that the debt matches the payments, and then you can model different types of debts, very advanced ones. And when it's ready, the financing module, then you come back to your calculation and just press update financing, and financing costs come to income statement, financing costs come to cash flow statement, loan withdrawals and repayments go to cash flow statement, and the loan balance is in the balance sheet. So it's the complete process then. You can also activate the loan cost, the debt costs during construction period to the main asset, the book value of the main asset, and depreciate in the same order as the main asset. So that's how it's typically done. You have a user manual here available, some 320 pages, but you can also just look up something when you're wondering about it. Just go through the content table, or maybe you use the search function Control F if you wonder what is modified IRR. You search for it, and you get the explanation in words and the formula, and all other ratios also, of course. And you could print out, of course, the manual. Furthermore, there's reports. There is change of language. There's many languages available. And also please notice that here is a link to an online learning portal where you can study yourself with different teams and different languages. So there is also the same way as today, there is a teacher showing you a case step by step, and also theory about it and case descriptions. So I recommend you do it. It's for free also for you. Yeah, let's start. So now we start to make the case, and the case, yeah, I explained it already. So let's just go forward. So to start a new file, there is, of course, you go from the menu if a file new, but there is also, you see there are different types of files. So the calculation file is here left, and you can just start with this button with a blank sheet to create a new one. The other one is to open an existing calculation. These are other types of files. The comparison file is the comparison table, proposal file is the investment proposal, financing file is the financing file. And you can act the same way with them, but let's start with the calculation, of course. So I press here for a new, and now when I have the most advanced version, the enterprise edition of Investor Excel, I can do impairment tests. I can do valuations of companies and corporate acquisitions for mergers and acquisition. And I can do business planning on business area or company level or group level. And I can do also investments and projects and profitability analysis. And so now, in this case, we just we could do the first or second, but let's take the first one, which is what the only version which is available in the smaller versions, Pro, Standard, and Light. Okay, so let's choose where am I saving, like in Excel. You work like in Excel, so you get to choose where you want to save. Do I have a good? Not really, but let's put it there. So it requested me to name and save the file. And I usually do so that I keep the in-file name. So in-file airline case. Because then I see what type of file it is, because in the same folder you have different types of invest files. Like in compass the comparison, in profit proposal, in finished financing, etc. There are still more. So I see by the name already, but it's of course up to you, whatever you name it. So number of years was 10 years. So in this particular case, we do it very simple. It's on an annual basis. But remember, you can choose to start a specific month, and you can, in the same calculation, have different periodizations. The program automatically adjusts for the periods. It checks if there's 3 months in the column, it adjusts for 3 months. If there is 12 months per column, it adjusts for 12 months. Whatever the periodization is, so it automatically adjusts change percentages, discounting, volumes, salaries, rents, that sort of things. So now we take from beginning of 24 and 10 years forward. And then there will be a residual column after 10 years. We don't include historical periods. So I just press OK. And it creates automatically now then the calculation sheet with 10 years modeling. So before that, there were no columns. It created those automatically now. And depending on what you choose, it creates. So now there's the 0 period, the beginning of 24. Then there's the 10 years annually, and then there's the residual column. And let's make this bigger so you have a better view like that. And new airline destination. 10-year. And let's make it 1 euros. So I can also do in thousands, and I can also convert to another currency later, but not for now. And the discount rate was given, it was 10.16%. So this is like the required rate of return from the airline to make this investment. That's the minimum required rate of return. But just so that you understand what it is, the discount rate. Usually it's calculated as a weighted average cost of capital plus perhaps some premium because of risk with the project. If it's a normal business, very standard normal business, then it's just you calculate what you pay as interest cost on average in the company, if you can deduct it in the taxes, and how much debt you have in the balance sheet in the financial statement closing of the books. Rest is equity, and what the owners are expecting for return for their investment in the company. So if it's 20%, so you see here this calculates 10.4. And now I can press use that one. Also, this required return on equity can be calculated a little more in detail using this capital asset pricing formula, capital asset pricing model. Let's use that one. So the point is, if I go back, if now the project needs to give a 10.4 return, otherwise the bank will not get their money and the owners will not get money. But if it returns at least 10.4%, then the bank is happy, the owners are happy, and everything above that is added value to the company. So it's very simple. And when you have set this discount rate correctly, then you don't need to worry about financing. That's only a secondary issue. Then when you decide to go for it, then you need to plan for the financing, but it doesn't impact the profitability of the project. That's the point. And now, if we include taxes, we put the tax percentage here, corporate tax percentage, but if we don't, we leave it out. And there are options, more options. I'm not explaining everything this time because we only have a short time. There is printout, there is locking, there is a finger button that takes you forward in a natural working order through the process of modeling. And there is the home button, which takes you to the starting screen, which also works as a menu. I can select to go to a specific page. The second page is contact information. The idea here is just what's your name, how can you be reached, when did you make this calculation, and what is this calculation about? Only short explanation, not anything long. Then we go forward and we come to the investment table. I will make this much bigger now, so you see better. So, and it put the heading what we used, it copied it to the first line, but we don't need to keep that. We can use our own headings, like the investments in this case is the aircraft, the restoration of airstrip, keep pumping in from airstrip, and we had a terminal building. The airline costs, the aircraft, the airplane costs 4,750,000. And when you enter costs like capital expenditure and other costs, OPEX, so then you use a minus sign. However, here, if you forget, you put the minus sign, program will react and guess that it was a mistake and offers to change it to negative. And now we pay this for this airplane one lump sum of one big lump sum. It's not paid in installments. If it would be an ongoing construction project, then you can split the payments. The restoration of the airstrip so that it can be taken to use. The story behind here is that it's there is an airport in this smaller city, but it's not in use. So, and we are considering now to start flying there, and to make it in order, we need to make a little bit of renovation therefore for getting it in order. And what did it say about the terminal building? I think terminal building is just simply owned by the municipality at this point. So nothing there perhaps. Yeah. So we come back to that one. So we are ready. And anytime, no, we are not ready. We need to depreciate also. So the airline will be depreciated over 10 years, 10%. There is many options here top left in the button. In this case, when it's just one payment, I can even take a shortcut and just put 10% here. And it will calculate straight line depreciation 10% per year. Then I can jump with this button to the end, and it's depreciated 0. But in the case 10 years is a short time for an airplane. It has much longer economic life. So now we need to take into account what is it worth after 10 years. It's in the case it's assumed that it's 1 million. Seems quite low, but then the restoration of the airstrip, same thing, 10%, and that's it. And by the way, okay, I can jump to the beginning here, and I can also on every screen you see in a program there is on the top there is a number 3. which means that it does not show all items which are on this page. It just shows an average. So if I go from 3 to 4, I get some more information visible. So I see how the book value per item is developing. And at the end, there is the sum of all investments and the sum of all depreciations and the book values. Okay, let's save with Ctrl S, and I will continue and go to model the incomes and costs. Model the business. So, and please remember again, so this could be anything. You would work in a similar way if whatever project you have. So we have incomes from passenger traffic. We have incomes from mail service revenue. And that's it. Two types of incomes. Could be other cargo also, but this was the case. The mail service revenue is simple. It's 200,000 per year fixed. So I enter one number on the gray row, 200,000 for 24. And please notice this. One number is entered. We use this button with the 12 in a box to distribute the value of the cell to selected periods, in this case, all, and in this case, without any change. So it's just 2 clicks. If I repeat, so this is selected, 1 click, and off it goes. And it creates like offset formulas. And for passenger traffic, we want to be a little bit more in detail of how we calculate the amount of passengers and sale of tickets. So I press this button because each of these rows, I mean, there is 10 types of incomes, there is 10 types of variable cost, there is 10 types of fixed cost, but each row can be split into 99 sub-rows. And each sub-row can again be split into 99 detail sub-rows. So there is more than enough modeling possibilities. And always remember, if you come short of anything in Invest for Excel, you are in Excel. So you can add your own sheets to have input values or technical calculations or your own form of reports or charts or whatever. Or for import and export of data. So switching from Excel to Invest for Excel, you don't lose anything, but you gain a lot. So passenger traffic, let's add 2 sub-rows. It offers to create 5, but I'm satisfied with 2. And the 2 rows are number of passengers multiplied with average ticket price. We make a little bit simplification here. Let's start with the ticket price. Ticket price is 280 euros. So enter 280. Now I'm making first a real calculation, not a nominal. Nominal would include inflation. This is a real calculation, and so no increase in price. We assume the same price level. But one number entered, and again, check 2 clicks, 1 click, 2 click, and it's gone. Then the number of passengers, actually, we're not just going to enter the number of passengers, we want to calculate that also a little bit in detail. So I can go deeper, to one level deeper. So this is how you do it. You go to the same gray button for passenger traffic, you choose number of passengers, and you create sub-rows, 4 sub-rows, and they come a little bit more light yellow, but same way. So these rows are added to that one, and that row is multiplied with that one, and then you get the total. So let's see. We will use the first row again for the same number of passengers. The other rows, removing the operators. I mean, there is also empty. There's plus, minus, multiplication, division, and empty. And now I'm just simply deleting, because then whatever I have on those rows, the program will not add them or multiply or whatever. It will not use them. But on this row with the plus sign, I will use an Excel formulas to pick from other items in whatever way I want. This is another way to do it. It's not a typical invest for Excel way, but it's a way. So yes, let's put increase. Capacity of airline. Cabin factor. Let's also check how full the plane is. Cabin. Like that. So let's start with the capacity. The capacity is 8,320. 8,320 is like the seating capacity of 40 multiplied with 208 times 2 one-way flights. Let's see if it gets there. 40 seats multiplied with 208 one-way times 2. Correct. No, not times 2. It's one way. So, okay. All right. Like this. 4 times 208 one-way trips. That's the capacity. And now let's first distribute the capacity. Again, I don't want the formula, I want just the value. And I can also choose to copy it as a value instead of formula. And then it puts the number hard-coded here. Then the increase, okay, for the first period, you increase it 5,000 because it's 0 before that. And then the increase is 300 passengers per year. 300, that's every year, so slowly increasing. And then the number of passengers is this one plus that one, an Excel formula. And now when there's an Excel formula, the program automatically recognizes that there's a formula and offers to copy it, which is exactly what we want. And now when we have the number of passengers, we can also check what's the cabin factor. I mean, we can't have more than 100% at least. So let's check, let's see, it's that one divided with that one, I guess. And let's format it. 60% for the first year. Now just copy the formula. And we go and check. For last year, it's 93%. Okay, it's about maximum already. But that's fine. It's been checked. So you see now we use the subrow to model that, and that is multiplied by that. And of course, I can just hide the subrow, and it's more easy to understand. It's 5,000 multiplied by 280, 5,000 multiplied by 280, and then you have the incomes. Increasing income because increasing volume. And you can always hide rows, you can hide them afterwards automatically, but if you also want to have like an overview while doing it, you can already now start hiding some of the rows to get a better overview of your case. So now you have the incomes total, and then we need to model the costs. And you can always rename We don't have raw materials and consumers. We have fuel cost is the biggest cost item. Fuel costs. They are variable costs. If we don't fly, we don't have fuel costs. Same thing is with handling costs. So every passenger needs to be handled. So if there's no passengers, there's no cost. So it's also variable costs. So those are the only totally variable costs. So I put those in variable costs, and then on the fixed cost side, it doesn't really matter where you put, but here the idea is that you think what is variable and what is fixed costs. So the staff costs here, that's good heading, and then we put maintenance costs. And rents later. Fuel costs. Okay, there is actually also two types of fuel costs in a way, because there's one cost flying an empty plane to distances, but then there is an increasing fuel cost for every passenger. So we have two headings for fuel costs. One is fuel costs empty plane plus fuel costs from passenger weight. And both, I need to go dig one level deeper to model, but 2 rows is enough. So, fuel cost per flight. Multiplied with number of flights. Simple enough. So number of flights was those 208. And fuel cost per flight was minus 720. And since both are values and they will develop the same way, in this case 0. So I can select them both at the same time and just click twice to get it out. And same thing for fuel cost per passenger weight, weight. So we have fuel cost per passenger multiplied with passengers. The number of passengers will increase, but we had a number from here above, here. So we do an Excel link, and now again the program recognizes there is a formula and copies the formula. The fuel cost per passenger weight is 9 euros. So 2 clicks and it distributes out that one, like that here. And handling costs, same way, we need 2 sub rows. We have handling cost passenger multiplied with passengers. So the cost is 15 euros minus 15. You always remember costs. You need to then learn to remember to put the minus sign. And here it doesn't react if you put a positive number, because it cannot know it could be a cost saving just as well, or it can be a volume. So I distribute that one, and then again the number of passengers. I take it from the top and copy the formula. So okay, I've done a lot of modeling here already. and then it didn't take me much time. So once you get a little bit used to the functions in the program, it's super fast to model anything. And then I can again hide some variable cost rows that I didn't need. Just so that you get an overview. Otherwise, I could do this afterwards automatically. But so we have staff costs. We have two types of staff. We have ground crew and air crew. Start the air crew and ground crew. And now let's make it simple. The annual cost of air crew is 200,000. And the ground crew cost is 50,000. And I will now distribute those numbers without change. So quite fast. Maintenance costs are, and I will simplify it, it's minus 7% of the cost of the airplane. And now actually I need to back a little bit, because now how Invest for Excel works now, when you have these buttons which refer to this page, so you sort of have a ceiling on top, you can't get up, I can't. So, but pressing this button removes that ceiling. And now I can link to the cost of the airlines, minus 7% multiplied with the cost of the airline here. And F4 to fix it. And okay, I didn't need the minus because it was minus. Start like that. So that's the maintenance cost, 332,500. And now you see, now I don't have any buttons here on top, and I would like to use the function. So now I need to press back again here, the heading, and then I have the button always available here for distributing, like that. We don't have a rents yet. No. Yep. That's it. And we are ready. We are done most of the, basically all the modeling. And now I could use the automatic function to hide the rest of the rows, which I used from the beginning. So then we have the gross margin, operating income before depreciations, EBITDA, EBIT, depreciations, financing items not yet included, and income before operations and taxes, and net income for the period, and some ratios here also. And let's go forward, saving, and next page is the working capital. So let's say you're an average. What did it say? I think it comes later, so we could skip it. We skip it for now, yeah. We come back to working capital. We go forward. So now we have an overview, the cash flow statement. We have the income from sales, and we have the variable cost, fixed costs. We have taxes, because we need to pay tax because we make profit. So the cash flow from operations plus investment, and we have the free cash flow. And every year's free cash flow is discounted to the beginning, and the discounted values are then added together here on cumulative discounted free cash flow. We see that we are on minus here towards the end, but actually on year 8 we break even to positive, and finally after 10 years we will have a net present value of more than 930,000. So far looking good. And here is a possibility then to add financing, debt and equity, because our bank account is now close to 3 million negative, so we need to cover that somehow. And it maintains a balance sheet automatically. Here is the airline, and there is the account, and there is the profits to equity, profit and losses, and not so much more in this case. We can look at KPIs on annual level, but let's come back to those later. This is the interesting thing now. Is it profitable or not? Is it feasible to do this investment? Total investment, required rate of return calculation, turn calculation point, and then present value of operative cash flows, 5.5 million. And we also have a residual value of the airline after taxes, of course, yeah. 1 million minus 20%, because it's all profit because the book value was zero. The book value was, we depreciated it to zero, and then it's all profit. So yeah, that's discounted to today. It's only 297,000. So this is the present value of business cash. We didn't have any reinvestments either. So then we deduct the main investment in the beginning, and the net present value is positive, around 30,000. If you look at it on a monthly basis, it corresponds to 12,266. The internal rate of return on invested capital annually is 14%. The modified version of it is 12.3%. The profitability index is 1.19. We get 19% more money back in today's value than what we invested. The payback time is 8.7 years. The monthly annuity is also a very useful indicator. If you consider that you have some existing assets and you're considering to replace them, but you could still continue to use the old asset for some years. It still works. It's not efficient and it's expensive to maintain, but it's positive cash flow every year. The option is to replace with a new one, which, let's say, a long economic life, let's say 15 years. For the new one, you can calculate NPV, payback, and IRR, etc. But for the old one, with positive cash flow every period, you cannot calculate payback or IRR. It's not possible. You can only calculate net present value. And you can't compare the 3 or 4 years net present value to a 15 years net present value. It's just not comparable. But this value is if the old asset gives a higher monthly annuity, try to use the old one as long as possible. If the new one gives higher monthly annuity, switch to the new one as soon as possible. IRR, I guess everybody understands IRR, but it works so that a profitable project like this, it starts to gather money on the account. The profits come on the account. But the formula assumes that does not stay there, it's reinvested in something else which gives the same return, 14%. The modified version basically works the same, but it's a little bit more cautious. It assumes that the money reinvested somewhere else gives this return, which is our required rate of return when it's reinvested. So, okay, now they are close, so it doesn't matter which one you use, but very often you get very high IRRs, 50, 60, 70, 80, 90%, and that money you will never see. It's imaginary money. So in those cases, this is more realistic. Also, IRR cannot always be calculated. If the cash flow changes sign often, like from plus to minus, minus to plus, then it might not be able to calculate. And also sometimes there is two mathematically correct results, and then investors will show two different values here, of which only one is the correct one. And then it's also easy to compare with modified IRR. Modified IRR is always calculated, and it's a good reference. And here is only a few indicators. Now we want to keep it simple, but of course here is a lot more. Like on every page, you can choose what to show and what to hide. So here are many hidden KPIs which you can just choose to show if you want to. It's up to yourself. Now, okay, if this is just one alternative, I push this to a new comparison table by pressing F1. So now this is one option. And then let's continue so that I will switch it from real calculation to nominal calculation. So let's go and save this one and then save it as with a new name. Save as with a new name, nominal. So yeah, I will need to adjust the discount rate. Let's assume that the inflation is 2%. So I need to include in the discount rate. And it's actually, you could simplify and just put 2% on top and then it's 12.4. That's perfectly fine. If you want to do it mathematically correct, there is some more things to consider. So it's like, okay, it should be 8, okay. Well, it doesn't matter, whatever. So we will take equals 10.4 plus 2 use percentages, I guess. Plus they multiply. Really? Plus 10.4% multiplied. And multiply with 100, because here we have it. Well, yeah. This is complex. Yep. There we have it. It would have been just as good just with 12.4, but exactly mathematically correctly, it's a little bit more complex. And okay, I'm running out of time. I should have made something else, but let's look at the investments. Okay, now we consider 2% inflation, which means that I also need to change this value from 1 million. So 2% per year in 10 years. So I will change that number to that time value of money by multiplication with the 1 plus 2% up to 10. Oh, well. No. Shift. So this is how you take into consideration 10 years of 2% inflation. You multiply 1 plus 2% up to 10. So 1.28, 18. And then let's go forward and adjust the ticket price. Also, we assume 2%. So I have 280 euros selected, and then I press the button again, and now annual change 2%. And I can also make it visible to the left. So this percentage share is dynamic, so if I change, then the numbers change. We put the same for mail service revenue, 2%. And for fuel cost, and for fuel cost per passenger. For handling costs, typically they would develop in a different manner, and that's why you always take it row by row, not just one common. But in this case, I'm simplifying now. I'm making all of the same percentage and maintenance costs still. That's it. Now this is a nominal calculation with inflation taken into account, and the result is then slightly different. And let's compare those. Slightly, quite a lot less. It's surprising, but I think I handled everything. But this is how you see how the comparison table works. So this could be different technical solutions, different suppliers, different size of investment, different time schedule, but you get them side by side, so you get to choose the better one. Oh, this is interesting. They go across. So this one gives a higher net present value, but this one gives a higher IRR, but this one gets a shorter payback time. Well, now these aren't really comparables either, because one is without inflation, one is with inflation, so they aren't comparable. That's just it. But okay, for the last minutes, let's just make some sensitivity analysis before I stop. So if you're a little bit uncertain what discount rate to use, it's not always so obvious. So you can see with different discount rates how it impacts profitability. It takes the one entered and increases and decreases with 10 plus 20%, and then but you can also enter any number here manually. You see that even with 15% discount rate is still profitable. Next one is the investment amount. What if we can buy the airplane 10% cheaper? MPV increases a lot. What about IRR? Because you can always choose whatever indicator you want to look at. Payback or IRR or whatever. So, so the return increases from 15.7 to 18.5 if you can buy it 10% cheaper. On the other hand, if it's more expensive, you see how much it falls. Next one is the income from ticket and cargo sales. So if it's less, 10% less, 20% less, gives 8% return, or 20% more than 2.5%. And also here below is from any selected year KPIs. You have in the middle, you have the case at hand, and then you have worst cases and better cases, how they show up for that specific year. And furthermore, there is then variable cost. If it's higher, fixed costs, how changes in fixed costs would impact the profitability. And then individual variables, you can choose any variable from your case. Like here is the ticket price, 280, 252, 224, 308, 336. How does it impact profitability? And you can have 6 different visible at the same time. What about the increase in passengers? We assumed 300 per year. But what if it increases less? It will impact the profitability, but it's not a catastrophe. So you can have many at the same time variables visible here. Then break-even analysis. If I go to income statement, to average ticket price, and I want to know how low ticket price can this case take. I select 280. I choose now this button, the red arrow down to ±0. It asks me, should I say break even by changing the active cell? Yes, you may. And it found me, I need to get 253 euros. That's the minimum, the break even. Break even means that MPV is 0, IRR is 12.61, profitability index is 1, and payback time is 10 years. And I can come back and just re-push the same button, and I'm back to my starting value. I can do this on any value. On the increase of passengers. Let's try that one. I haven't tried that before. 126 per year minimum. And undo. What is the maximum cost for the airplane? No, OPEX, yeah. 389. Undo break even. Like that, on any value you can do break even. Then there is still charts like tornado chart, which gives you a good overview of the different variables. Tornado. So really shows you now then which variable impacts more and which variables impact less. So where to focus in your calculation. Ticket price is the most sensitive item. A change of ticket price of 10% increases or decreases the net present value with 810,000. Volume comes second, number of passengers. 10% increase or decreases number of passengers gives 40,000. 10% higher or lower investment cost gives an impact of 568,000. Only the airplane, 250,000. Maintenance costs, 157,000. Staff, 180,000. So you see where to focus. It's up here. Okay, there is many other different types of sensitivity analysis and charts, but I see that I'm already past my end time. So I thank you very much for joining, and I will end the recording. You will get the